Picture this, it's 1986 and investors staring at company earnings reports are scratching their heads. Earnings per share go up, but the stock price tanks. How can that be? Alfred Rappaport throws down a challenge. Traditional accounting numbers mislead more than they inform. What if you've been fooled by ROI and EPS all along? The secret to real corporate success is what's in the spreadsheet, but what truly creates shareholder value. Let's dig into why and how. First, Rappaport exposes the cracks in the classic tools CEOs swear by. Earnings per share, ROI, and ROE seem solid but hide dangerous illusions. At Alcoa in the early 80s, EPS was climbing steadily, but the stock price lagged. Investors got frustrated, waiting for a payoff that never came. Rappaport shows how managers chasing EPS growth often sacrifice long-term value for short-term gains, a recipe for shareholder distrust and volatility. Think of ROI as your car's speedometer, but stuck on one number no matter what road you're on. It tells you returns based on accounting rules, not the actual market cost of capital. So a business might seem to score a high ROI, but is actually underperforming when you consider the risk and future cash flows. ROI and ROE ignore whether capital costs are covered. It's like measuring how fast you run, but forgetting you owe rent for the shoes you bought. Rappaport reveals that companies often generate accounting profits while destroying shareholder wealth, a blind spot with costly consequences. So what's the alternative? Rappaport proposes flipping the lens entirely. Focus on cash flow and value creation, not accounting illusions. Remember Gillette's acquisition of Duracell? Rappaport breaks down how discounted cash flow (DCF) allowed them to see beyond Duracell's accounting numbers and evaluate its future cash creation. This approach helped Gillette pay a fair price and strategize for real value, not just a glossy earnings snapshot. SVA is like a GPS for management decisions. It calculates how much value each business unit adds after covering its cost of capital. Managers who use SVA stop chasing vanity metrics and start focusing on what truly moves the needle for shareholders, aligning incentives with actual wealth creation. Threshold margin works like a speed limit. It's the minimum return a project must earn to justify the investment. Think of it as your financial guardrail, preventing companies from overinvesting in mediocre projects that look good in accounting but burn cash and destroy value. Rappaport closes the loop by showing how market prices and smart compensation can guide managers toward value creation, if used right. Market prices act like an orchestra conductor, reflecting countless investors' expectations about future cash flows. Rappaport warns CEOs not to ignore market signals, because the stock price is a real-time scoreboard of whether management strategy is creating or destroying value. He points out how tying executive bonuses to accounting metrics leads to gaming and short-termism. In contrast, compensation linked to shareholder value added or economic value added aligns managers' incentives with lasting wealth creation, making them think like owners, not just employees. Take Gillette's Duracell deal again. Rappaport shows that many mergers fall apart because leaders focus on revenue or cost synergies alone, missing the bigger picture. Does this combination create real shareholder value? Without that focus, mergers risk becoming expensive distractions instead of growth engines. Remember that moment with Alcoa's puzzling EPS growth. By flipping your view from accounting numbers to shareholder value, you stop chasing illusions and start making real wealth. Next time you look at a company, try this. Measure their cash flow, their threshold margin, and ask if management's incentives align with your wallet. That's how you separate the value creators from the noise. Subscribe for more book summaries like this one.